I hate to do this right now, but I'm gonna have to have a press call first thing, and I really don't know what I'm gonna tell them.
Tell them Lehman exacerbated AIG. The simultaneous payouts of CDOs and credit default swaps put catastrophic pressure.
Go back further.
The global pool of investment capital.
She has to do this in English. Start with the homeowners.
Okay, here's how you explain it. Wall Street started bundling home loans together, mortgage-backed securities, and selling slices of those bundles to investors. And they were making big money. So they started pushing the lenders, saying, come on, we need more loans.
The lenders are already giving loans to borrowers with good credit, so they go bottom feeding. They lower their criteria.
Before, you needed a credit score of 620 and a down payment of 20%. Now they'll settle for 500, no money down.
And the buyer, the regular guy on the street, assumes that the experts know what they're doing. He's saying to himself, if the bank's willing to loan me money, I must be able to afford it. So he reaches for the American dream. He buys that house.
The banks knew securities based on shitbag mortgages were risky.
You'll work on shitbag.
So to control their downside, the banks started buying a kind of insurance. If mortgages default, insurance company pays. Default swap. The banks insure their potential losses to move the risk off their books so they can invest more, make more money.
Well, a lot of companies insured this stuff. One was dumb enough to take on an almost unbelievable amount of risk.
AIG.
And you'll work on dumb.
And when they ask me why they did that?
Fees.
Hundreds of millions in fees.
Yeah, she figured the housing market would just keep going up. But then the unexpected happens.
Housing prices go down.
Poor bastard who bought his dream house. The teaser rate on his mortgage runs out. His payments go up. He defaults.
Mortgage-backed securities tank. AIG has to pay off the swaps. All of them. All over the world. At the same time.
AIG can't pay. AIG goes under. Every bank they insure books massive losses on the same day. And then they all go under. It all comes down.
The whole financial system? And what do I say when they ask me why it wasn't regulated?
No one wanted to. They were making too much money.
While you'd like to think that no bank would be stupid enough after 2008's crash to hand out money to people who couldn't pay it back, the simple fact of the matter is, because America has given away its industrial complex to foreign nations, specifically giving away our low-end factory jobs to other countries and relying on consumerism rather than production, we've put ourselves in a situation where each and every year the American people become less and less productive. And when I say less and less productive, I mean that we lose more and more of our people with vocational skills, and what ends up happening is more and more of them go into colleges, and rather than picking the harder subjects, rather than being forced to go towards math and science in order to be the innovators of tomorrow, these people are allowed to take out massive amounts of student loan debt in order to get useless liberal arts degrees, such as film degrees, and they even have a class called Martin Scorsese film, where you learn about feminism and transgenderism in different films. It's so ridiculous until it doesn't even bear repeating. To make a long story short, I just wanted to make this short little video to talk about a couple of different types of mortgages and loans that you're gonna have to watch out for. And the reason why I say watch out for is because a lot of people aren't either in the know enough, or not smart enough, or not savvy enough to hire real estate lawyers to help them when they are about to sign on the dotted line for a property. There's the interest-only mortgage, and the interest-only mortgage obviously allows you to pay interest only on a mortgage. They used to have what's called the ARM loans, which they actually still do, but a lot of the different products have been eliminated due to the fact that the 2008 crisis happened. When you see an ARM loan, steer clear of it. An ARM loan, such as a 2x28, for example, means that you're going to pay an interest-only on your mortgage for 2 years, and then the rate may become fixed or adjustable for the next 28 years. Now, it depends what the term is, because the thing about it is you may start out with a fixed rate loan that is 2 years, and then it becomes a 28 ARM, which means that it'll be adjustable rate, and it adjusts with the market. The problem with that is you never know if the market's going to go up or down. So what could be a $1,000 a month payment right now could turn into $1,500, or it could turn into $1,700, or it could turn into $2,000, and you just don't know what's going to go on. If you live in certain areas, the ARM loan is extremely dangerous. If you live in New York, like I do, the ARM loan is extremely dangerous because as property values and the market goes up, you get screwed. However, in certain parts of the country like North Dakota or places where not a lot of people live, like Alaska, an ARM loan really doesn't make a difference, because as long as you're paying, they really don't care as long as you keep those payments up. But for the most part, your market's not going to fluctuate that much. The problem with an ARM loan is that if you're only paying interest, you're not touching the principal. If you're not touching the principal, ultimately, in the long term, you're not really going to have paid down this loan at all. And the scary thing is, every now and then you hear clients who've taken ARM loans who suddenly realize the difference between principal, interest, and their mortgage payment, and they call in and they're very upset. I try to steer people away from interest-only payments. My thing is fixed 30-year mortgages are probably your safest bet. Now, there are some banks popping up which offer what is called 40-year mortgages, and some banks are even trying to offer 50-year mortgages. And I kind of think the 40-year mortgage may end up being a good solution. And the reason why is because retirement is based on the belief that most of us are going to marry in our 20s. We're going to buy a house in our 20s. We're going to stay married, which, you know, the divorce rate is higher than 65% right now. But anyway, they think that we're going to stay married until our 60s, and then we're going to be able to retire, and we'll walk out of the job and start collecting Social Security, 401ks, and whatever savings that we have. The problem is, marriage for many people has been pushed back about 10 years. So you have a lot of people not getting married and not buying houses until they're 30 or even 40. So that means that if you get a 30-year fixed mortgage when you're 30 or 40, you're looking at, you know, paying on that mortgage until your late 60s, which means that you'll be entering your retirement pension. You'll be entering a fixed income market at that point, and you may have trouble paying off your house. So ultimately, in order to get people into these houses, offering these longer term mortgages may be the only way to make the price up front, the loan amounts, or make the monthly payments slightly more affordable to get them into these places. But ultimately, we really don't know what's going to happen until the next president gets in, because right now you got a lot of people on a campaign trail just offering handouts, talking about how they're going to save your student loan or how they're going to save your mortgage. So the problem is, the future is something none of us really know, and we don't know what's going to happen until we have a newer or better government installed. And that's going to take us, 1 year, 2 years tops? So we'll just have to wait and see. What you should do is absolutely make sure that you steer clear of the negative amortization loan. A negative amortization loan is extremely dangerous because they're similar to the interest-only loan, but the problem is the payments aren't enough to cover the interest. So what used to be you just paying the interest and not the principal, now you're making payments where you're not even covering all of the interest. That's extremely dangerous because the interest starts to compound, and you're talking about a situation where you could buy a $300,000 house, you could make every single mortgage payment that you agreed to, and then at the end of that term, you're looking at a house that you now owe $500,000 on. But, you know, granted, that's not going to happen in the short term, but you could buy a $300,000 house and end up owing $400,000 on it. I think that's a little bit more reasonable. Do not, by any means, take a negative amortization loan. Then there's the balloon mortgage. You really don't hear about balloon mortgages anymore, But basically, a balloon mortgage is where you get a mortgage, and it usually has relatively low monthly payments, and it amortizes over a 30-year period. The problem is the payments don't chip away at the principal. So what ends up happening is a balloon mortgage demands that after a set number of years, usually like 7 or something, that you have to make large bulk payments up front. So that could mean that you're paying on a house right now, and then all of a sudden you owe $200,000 or $100,000. And if you don't have it, guess what? You're out on your ass. A balloon mortgage is not a good idea. Once again, the 30-year fixed is probably your safest bet. Then there's cash out refinancing or getting home equity loans, where basically the banks can hand you a credit card that allows you to tap into the equity of your house. The problem with these things is they take advantage of Americans' consumerism, and it can put you in a situation where you think that you have more money than you do. You take out home equity loans to buy a car or a boat or something, and next thing you know, you end up owing a lot on this HELOC or home equity. That's how you shorten the word, home equity line of credit. But if you end up owing a lot on a HELOC, you could end up in a situation where you're paying your mortgage, but you can't afford to pay back the HELOC because the adjustable rate has probably gone up. And that can put you in danger of losing your house. So you really need to be careful with that. My recommendation is you don't buy stuff that you absolutely don't need. But the problem is, in many situations, a lot of people are taking out HELOCs just to pay for medical treatment and medical care. So when they're talking about medical treatment bankrupting people, this is one of the things that sometimes that comes up, that people have home equity lines of credit just so that they can pay for a liver surgery or a heart surgery. That's just, it's unavoidable, it's sad, and it's unfair, but the problem is that's, unless you actually have the cash, unless you have a good job, sometimes you end up in situations like this. You absolutely want to avoid this at all costs. A home equity line of credit should be used for nothing more than making a major emergency repair on a house that you absolutely didn't see coming and that you don't have the cash for. That could be something like a tree falling on your house or a tornado hitting you, at which point I say you should move out of that area, because if you're in a place where there's tornadoes, you shouldn't be there. So, some people don't want to move, but all I'm saying is that, the government ain't going to bail you out. They're going to give you these loans from FEMA, but they're not going to bail you out. So my recommendation is you stay away from home equity lines of credit unless you have some kind of major emergency repair you have to make. There are a lot of scam artists out there, and they like to take advantage, especially of immigrants who don't speak English very well. A lot of immigrants come to the country, they establish new lines of credit, and once they establish those lines of credit, their FICO scores go up. And some of these people have been in the country less than 2 years and have FICO scores as high as mine, like above 800 for their lowest score, and some of them like above 830 for their middle score. But that's only because they haven't been in the country very long, and their credit scores go straight up because they haven't had time to default on anything yet. There are a lot of companies out there that like to try to take advantage of these people and get them to buy houses. And the reason why is because the brokers get paid commission using the equity in some of these properties. Now, that may be a little harder to do now than it was in 2001 through 2006, simply because many of the houses have had their equity sucked out of them. And a lot of these houses are underwater on their mortgage. For instance, the house actually costs less than its mortgage balance. So that means that you're underwater on your loan. But a lot of these people don't know what they're doing, and they need an advocate. So what you end up seeing is a lot of mortgage brokers that speak dual languages or 3 languages, and they love foreign buyers because they don't know the laws of America. They're desperately in need of a house, and they need it immediately. And they're willing to sign just about anything without understanding what exactly it is. These ninja loans, no income, no job, no assets, these things are making a comeback simply because there's a lot of unscrupulous mortgage brokers out there. Now, fortunately, I'm not one of them. So that's why I don't mind making a video like this to try to keep people from making these mistakes, because I try to do everything above board. But in any event, that's my video. And if you have comments and everything, feel free to post them and everything. So thanks a lot for listening.